So, you own some stocks. Awesome. But are they really doing all they can for you? I mean, are they just sitting there? Today, we're diving into a strategy that can make your stocks work a whole lot harder, the covered call. We're going to break down what it is and exactly how you can use it on the SoFi platform to start generating some income.
Seriously, think about it. It's a question a lot of us investors just don't stop to ask. You did the tough part, right? You researched, you picked your stocks, you bought them. But what if those exact same shares, the ones you're holding for the long run, could also be paying you like a regular paycheck right now?
So here's the game plan for today. We're going to start with the basics of making your stocks work, then get right into what a covered call actually is. From there, we'll do a step-by-step on SoFi, cover the real-world risks, touch on some more advanced stuff like rolling and taxes, and finally help you figure out if this whole thing is even worth it for you. All right, let's jump right in. The first piece of this is really just a change in mindset. You're shifting from being a passive stockholder to someone who's actively looking to generate income from the assets you already own. This is super common. You buy shares in a company you believe in, you hang on to them, and you just hope they go up. And that's a perfectly fine strategy. But there are other tools in the toolbox, like the one we're talking about, that can potentially turn those holdings into a source of cash flow without having to sell a single share. So what is this strategy, really? Let's peel back the layers and unpack the covered call. I want to get right into the nuts and bolts of how it actually works. Okay, in the simplest terms I can think of, you own the stock and you sell someone else the right, but not the obligation, to buy that stock from you at a set price by a certain date. It's kind of like you're selling a coupon for your shares. And for selling that coupon, you get paid a fee in cash right up front. So these are the absolute must-haves for this to work. First, you've got to own at least 100 shares. Why 100? Because one single options contract always controls 100 shares of a stock. Then, you sell that contract, you immediately collect that cash payment, that's called the premium, and in exchange, you agree on a price, the strike price, where you'd be okay parting with your shares. Now check out this chart, because it shows the trade-off perfectly. See that flat line at the top? That's your capped profit. You get that premium, that cash, right away, but you're agreeing to give up any potential gains if the stock shoots way past that red strike price line. But on the flip side, that premium you collected also gives you a little bit of a buffer, a little cushion, if the stock price decides to go down. All right, enough with the theory. Let's get our hands dirty. How do you actually do this? How do you place a covered call trade in the SoFi app? Let's walk through it step by step. Now, this is a pretty big deal for anyone on SoFi. It's a relatively new thing. The platform now offers what are called Level 1 options, which are basically the simplest, least risky tier of options trading. This one move opened up income strategies like covered calls to a much, much wider audience. And here it is, the playbook, straight from SoFi's own help center. It really is a simple 5-step process. You log in, find your stock, go to the options trading screen, pick your contract details, that's the expiration and the strike price, and then you just tap sell. They've really designed it to be as straightforward as possible. And this shows you the potential. In a real-world example, one trader used covered calls on SoFi stock itself to help juice their return to 24% in just 2.5 months. Now, let's be super clear, that is an absolutely stellar result, and it is not typical. But it does show you the power that options can have in generating income. But, with any investing strategy, that kind of potential doesn't come for free. There are always risks. And sometimes the reality of trading can be, well, pretty frustrating. So let's hear what actual SoFi users are saying about all this. So here's the core conflict, right? The dream is this beautiful, steady stream of passive income. You just click a few buttons and collect checks. The reality, though, can mean watching your stock rocket up without you, or, as we're about to see, dealing with tech glitches at the absolute worst possible moment. So first up, here's the dream scenario playing out. This Reddit user is doing it successfully. They're honest, right? They're not getting rich overnight, but they've made a couple $1,000. And they call it what it is, easy passive income. For a lot of people, that's the whole point. And then, literally on the other side of that coin, you have this. Same platform, totally different experience. This user claims a missed trade cost them $5,000. It just goes to show you that the financial stakes here are very, very real. And this brings us to a really critical point. It's one thing to accept the risks of the strategy. That's on you. But what do you do when the platform,
The very tool you need to manage that risk fails you when you need it most.
Oof, this quote is just a gut punch. I mean, imagine this. You're sitting on a $15,000 profit. You go to cash out, and the app just won't let you. 5 hours later, it finally works, and all of those gains have vanished. Just gone.
Now, in the spirit of fairness, SoFi's official account did respond in that same Reddit thread. They acknowledged there was an outage, they apologized for it, and they confirmed that it was fixed. So it's important to see both sides of the story, the real user frustration and the company's public response.
Okay, before we wrap up, let's just briefly touch on some next level topics. Because once you get the hang of the basics, you're going to want to know about things like rolling your options. And of course, how this all gets taxed.
So let's say your stock has gone up, your shares are about to get called away and sold, but you've changed your mind. You want to keep them. This is where rolling comes in. It's a way to close out your current trade and immediately open a new one further out in time or at a higher price, basically buying yourself more time or more room for the stock to run.
And then there's taxes. Look, this gets really complicated really fast, but here's the big takeaway. Not all covered calls are treated the same by the IRS. If you sell a call that's already in the money, meaning the strike price is below the current stock price, it can actually pause the clock on your holding period. And that could turn a nice low-tax long-term gain into a much higher-tax short-term gain. And of course, please remember, this is not tax advice. Talk to a pro. So, we've looked at the income potential, the step-by-step how-to, and the very real risks and user frustrations. Which brings us to the ultimate question. Is this strategy actually right for you and your portfolio? And at the end of the day, it really all boils down to this one simple question. You are making a trade. You are trading away potential, explosive upside for a smaller but guaranteed bit of income right now. There's no right or wrong answer here. It all comes down to your goals, how you feel about the stock, and what you can stomach when it comes to risk. It's a trade-off that only you can decide on.